you add that to cash test, you're really in trouble. and in some countries, like in some jurisdictions, there's a more informal test, which is a trust test, where the company is known to be in trouble and has a reputation of having tried to raise capital and failed.
Hey, welcome back to another episode of Angels, Exits, and Acquisitions. I am your host, Jeff Barnes, and today I got a chance to interview Charles Thomas from France about corporate finance, institutional money, sell-side dynamics with companies, restructuring, all sorts of really cool stuff in the finance world. And I find the financial world, it might seem a little bit boring to a lot of people, but I find it really cool because it's really how the world goes around when we talk about, having free enterprise and capitalism. Well, none of that could work without the financial markets. And there's a lot of little hidden gems in this interview with regards to financial markets and how you can leverage those to grow your business, to exit your business, to make your business wildly profitable. And it's a really great interview. We go for about 30 minutes, so a little bit longer, but that's okay because there's some really good gems in here. As always, like, subscribe, and share, and look forward to hearing about your comments about this episode. Take care.
Welcome to Angels, Exits, and Acquisitions, the place to learn how to fund, scale, exit, and massively profit as an angel investor or entrepreneur. Brought to you by the Angel Investors Network. And now, here's your host, Jeff Barnes.
Hey, welcome back to another episode of Angels, Exits, and Acquisitions. I'm your host, Jeff Barnes, and I'm joined today from France with Mr. Charles Thomas. Charles, how are you today?
Very good. Thank you. Glad to be here.
Thanks so much for being here. Really appreciate it. Now, you and I were talking just before we got going here about your illustrious career. You've had a lot of fun things that have happened in your career that I think people are going to be really excited to learn about. But why don't you give everybody a little bit of background about who you are and how you got to where you are today?
Sure. Thank you very much. So I'm the CEO and founder of a company called Cognitive Corporate Finance. We are a sell-side corporate finance firm. So our role in life is to help companies raise capital or shareholders of companies find acquirers, primarily from institutional investors. I created the company after various types of experiences, starting in the 90s, working in corporate strategy out of London, working for large multinationals, dealing with European issues, strategic expansion, reorganizations, etc. In the 2000s, I moved to Paris and worked on restructurings and turnarounds for KPMG Restructuring, and lastly with Alvarez and Marsal in 2008, 2009, during which I had, as I mentioned, the good fortune of working on the Chapter 11 of Lehman Brothers, selling assets and trying to extinguish liabilities as part of the Chapter 11 process. That taught me a number of things, which I brought into what is now Cognitive Corporate Finance. Mainly the fact that at the time, pre the great financial crisis of 2008, 2009, a lot of overcomplexity basically took the market where it ended up down for a good 3, 4, 5 years, depending on the country in which and the market in which you're operating. And we don't need to revisit the subprimes and CDOs, CLOs, and cheap ratings, overly cheap ratings from the rating agencies. But basically, a lot of transactions were structured that were really disconnected from economic reality at the time, I think, to put it shortly. And one of the things I wanted to do, and we found was really a request from our clients, is to get back to basic fundamentals, especially when you're looking to raise capital, helping or advising a company raising capital. What kind of capital and why? And that goes, that requires being able to answer the question: what kind of risk are we asking the investor to bear? And therefore, what kind of returns should that risk command on behalf of the investor? So that's where we started the journey of cognitive corporate finance, and which very quickly took us to carrying out our own fairly extensive survey of the alternative institutional investor space. Alternative institutional investors are for short, investment funds of all shapes and sizes. So private equity funds, venture capital funds, private credit funds, real estate funds, corporate VCs, corporate M&A departments, but not just funds. So corporate M&A departments, are institutional but not a fund. And then you have other investor types like endowment funds, pension funds, etc. And the reason we went down that road was because we found that the good thing about institutional investors is that they have, by virtue of who they are, they're in order to raise their own capital, they need to come up with an investment thesis. What are we going to raise capital for? And what kind of market opportunity are we going to try to exploit? And that investment thesis then translates into an investment mandate, whereby they're entitled to do a certain number of things and prohibit themselves from doing others. And that ultimately, ends up into, we've synthesized it into 4 main criteria for capturing investment mandate, which starts with the geography. Where can that investment fund's capital go, or that corporate's capital go? So, as far as geography is concerned, for example, a lot of U.S. funds will have be domiciled in Delaware, and their capital will be able to go to typically U.S. and Canada. It's very classical geographical remit. A European fund will be domiciled in Luxembourg or elsewhere, and they'll be able to invest in the EU and the UK. So that's what we mean by geography, not where the fund is, but where its capital can go. So that's criteria number 1. Criteria number 2 is sector. Of course, usually the general partner of a fund typically consolidate its experience in a given area, healthcare, transport, telecoms, biotech, etc., and as a result, will invest in a particular space. The third criterion is ticket size. How much capital do they place in a given transaction at a given moment, and that is the direct function of the assets under management of that fund. So it's really important to know how large the fund is in terms of AUM. A small quote unquote VC fund of 50 million won't place the same sort of capital as a 5 billion infrastructure fund for obvious reasons. So understanding and knowing how big the balance sheet you're talking to is obviously a key consideration. So that's the third criterion. And the fourth one is, where does that fund place its capital in the balance sheet of the business, or outside of it? Between the least risky, cheapest capital, which is senior debt, and the most risky, most expensive, which is equity. There's a whole, there's a layer cake and endless variations on a theme, where you have funds that do senior debt, others that do junior debt, or others do mezzanine, others that do preferred equity, and then equity, and then you can do endless additional changes to capture a bit of risk here with a bit more upside. Sometimes you have funds, of course, that invest outside the balance sheet, that invest in real assets like real estate or in structured finance. And if you understand, if you've mapped all those, and if you've captured the data on these investors, which we've done for about 20,000 of them, it's quite easy to be able to identify for the relevant investors for a given transaction. And that has helped us to advise a number of companies from, and the way we advise companies is taking from start to finish of a transaction. So the start of a transaction is documenting a financial instrument. So a financial instrument is, the way we explain to our clients, is the amount of capital we're looking for, $20 million, matched with the rights to which you're offering in exchange for that 20 million. Is it 20 million in equity or is it 20 million in debt? Those are completely different financial instruments. Documenting, it means drafting info memo, sometimes doing evaluation, frequently doing evaluation, preparing data room, making sure the financial model is up to scratch and the company is able to engage with institutional investors. And then going out to the selection of investors we've identified as being relevant on those 4 criteria I've mentioned, helping negotiate terms, getting our clients in front of them, helping them negotiate terms, helping them navigate the due diligence that lands on them, and going all the way to the closing and making sure the cash hits the bank account it's supposed to hit.
Before continuing, please subscribe and share this video to help us reach more people and stay notified of our latest releases. Now, let's continue watching and learning.
Well, that is, you got a lot going on then, Charles. It's a lot of background. I really appreciate that. And, the thing that I keep hearing over and over again, as you're talking about this, is risk mitigation, right? I know you're not saying that word necessarily, but, when you're talking about helping companies raise the capital for whatever purpose it might be, there's an entire process, a thought process that goes into it, a strategy that goes into it. I'm glad that we got into that, but it sounds like a lot of that was built because you started in corporate risk and restructuring a long time ago and saw a lot of bad things that happened, right? And, things were happening maybe at the corporate level that companies didn't foresee, or they had to go through restructuring, which maybe you could talk a little bit about that. Like why would a company have to go through a restructuring, especially when they're some of the biggest companies in the world? What led up to it? What happened? And then maybe you talk about like the example of Lehman Brothers, which was a domino effect for a lot of other things as well.
But that's a lot of questions. So, you're right. I mean, risk mitigation is part and parcel of the investor's work. Every investor, needs to be able to gauge the risk he or she is going to bear for the transaction. So, first question: what happens? What brings the company to bankruptcy? You have basically 2 to 3 stress tests that determine whether a company is bankrupt. The first one is a cash flow test, which is basically a company is unable to meet its short-term liabilities with its short-term assets, so it's not able to pay its cash obligations today or within next week. That is a test of insolvency. The second one is a balance sheet test, where we basically have negative equity and the company is basically negatively capitalized and needs to raise additional capital. And if you add that to cash test, you're really in trouble. and in some countries, like in some jurisdictions, there's a more informal test, which is a trust test, where the company is known to be in trouble. And has a reputation of having tried to raise capital and failed. And basically it's a market test, so that once you, if you begin to think you're going to hit one of these situations in the near to medium term, you need to basically start planning for a restructuring. And the good news is that in most developed countries, the US, which has been I think a leader in space with the Chapter 11 regime, but also in Europe, which is European countries which have adopted very, very similar mechanisms. There's a lot of anticipatory mechanisms available to companies, so that they don't have to wait till they're really short of cash on Tuesday to go and restructure themselves. They can plan 6 months in advance and say, look, things are looking bad. If we let them fester, we're gonna, basically faced with liquidation. Let's not wait till then. Let's plan ahead and see what options are available to us. And that's what a restructuring. That's what brings a company to restructuring. What are the typical outcomes of restructuring? You either have a trading out of a restructuring. So you enter, let's use Chapter 11 as an example. You enter to a Chapter 11, you have 4 to 6 months to present a plan to your creditors. Let's say you do it well, your creditors agree. you restructure your debt, and you trade out and you exit the Chapter 11 process. You're now solvent again. Everyone is happy, probably except your shareholders are probably the ones who got squeezed the most in the process, but the company survives. Option 2 is selling the business as a going concern, because the company, the management and the creditors decide that this management isn't the management to take the business out. No one's going to trust them anymore for a whole range of reasons. But the business is still viable, and under a different stewardship can be prosperous again. And that's a trade sale of the business as a going concern. And then the worst case is liquidation, where no one believes that this company is going to go anywhere, and therefore it's sold for parts. So just instead of selling the car as a functioning car, you sell the tires, the motor, the windshield wipers, and that is deemed to be, and that happens when people believe that the parts are worth more than the whole. So that's what restructuring is, and I think a lot of investors these days have kind of got back, especially in the venture capital space. A lot of investors that had followed a fairly exuberant route, up until 2-3 years ago, where there was a dynamic, and particularly in the U.S. market, which really, I wouldn't say bubbled, but companies found it really easy to raise capital for Series A on the assumption that there would be, you can raise 10 million Series A and be fairly confident that within 18 to 20 months, 24 months, you could raise a Series B for 50 million, and then within another 2 years, you could raise another 50 million in Series C, and
right.
And a never-ending upward progress. That has stopped brutally 2 years ago, and this is where a lot of VCs and not PE funds, not credit funds, VCs really took some major hits. And we've seen that both in US and in Europe, where basically a lot of them are nursing losses, where a lot of the portfolio companies just basically got liquidated, shut down. It wasn't just down rounds; it's literally liquidation of companies and portfolio companies. And now the VCs are still there. They're still VCs with capital to deploy, but their approach is hugely more conservative, right? Now the message from a VC is, look, I have capital to give you. I will give it to you if you convince me that you can manage this capital, and that you are not going to make the assumption, dear company, that there will be money 2 years down the road. Assume this is possibly the last shot of capital you're going to get. And if it is, I need you to be able to deliver to me a functioning, adult, profit-producing, cash flow positive company, so that, if ever there's a crisis, we know the business is sound and you're not going to rely on third parties to bail you out. So that's a radically different approach for a VC, to actually have to think much more frequently and much more structurally what could go wrong. Typically, VCs didn't think of what could go wrong. What could go wrong?
And that was something that I found so incredibly strange, to be quite honest, when I got into this world of raising seed capital and going to your angel round, your Series A, B, C, and things like that. And it's exactly what you said, which is a lot of these companies didn't have any sort of profit metrics. They didn't have any profit drivers. They said growth was the only thing that mattered, and eventually the profit will come. And that didn't really reconcile with my brain of thinking, okay, the way that you make money is by having lower expenses than you do revenue, right? Yeah. And we'd see these companies just grow and grow and grow because they just keep getting money in the door. And that's when I realized, man, something's a little bit strange, right? There's this interesting world of capital marketplace, and investing and financing that I did not understand, because my understanding of business was, if you're profitable, you pay dividends to shareholders are happy, the company keeps growing. But if you're not profitable, how do you pay dividends and how do you keep the company growing? And this is where that world of finance really comes in. And so, getting to the point of raising capital, and I think even to the point of, some of these companies failed, they got quote unquote too big to fail, right? They saw these opportunities to just keep raising money, not just at a startup level or, early stage companies, but even some of the major institutions, right? You talked about a Lehman Brothers restructuring and bankruptcy as a result of, like we said, the collateralized debt obligations, the CDLs, these different unique financial products. And they were raising money to do a lot of this, weren't they?
Yeah. So so on the VC front, you're right. I think a company ultimately can only survive if it generates a profit on a sustainable basis. But it is true, to be fair to VC investors, that there's some big bets that you want to make, or even some medium bets that you want to make that require more patient capital, that you can accept the fact that a company may not generate profit for 3 years, right? Because if you compare creating an app or a B2B SaaS system, it takes a while to program, to develop the program. It takes a while to sell. Once you've started selling, it takes a while to generate profit. And yet, ultimately it could make sense. And lots of businesses have grown and been profitable using that model.
Well, I use the example of the pharmaceutical industry, right? Like here in the United States, at least, I know the EU is a little bit different, but similar kind of ideas, which is there's a lot of R&D that goes into a new drug being developed. And I have my own qualms with the entire pharmaceutical industry, but we stay away from that generally because you have no idea if something's going to pass FDA requirements and multiple rounds of testing and eventually, but it takes a lot of money to get there, which is why there's so many big pharma companies that can do this, but not too many startups that can survive, right? Because you have to raise so much money and you may not see any profits for 5-10 years down the road.
I think you're exactly right. I think the pharma space is probably the worst, quote unquote, from the point of your time. Because it's not just the FDA approval, it's everything that precedes it, which is developing the drugs, right? And developing the drugs and the testing required is a years-long process, 3, 4, 5 years before you can apply it for FDA approval. And that takes another couple of years. And then you can start selling after that. So you've got, 7 years easy that you need to fund. So with the most VC, unlike, for example, setting up a franchise for McDonald's, right? You buy the franchise, you fund it, and 2 months you're selling hamburgers and making a profit in month 3, right? That's a shorter term business proposition. But so I think I just wanted to say that about the VC space, because I think they do try to do bigger things than selling a McDonald's, funding a McDonald's franchise.
There's definitely space. There's no doubt about it.
Yeah, but yeah, I think then it's a question of and we saw this in the crisis in telecom crisis in 1999, and we saw that in the one, it's not really a crisis, but let's say a thaw or a slowing down, of the VC, significant slowing down of the VC space and the IPO market to go along with it, is the fact that, well, people now needed to, they can't just say, oh, we'll just value a business at 10 times turnover or, $2 per click, which is meaningless if you ultimately don't bring it back to profit, cash flow. And I think now what we're seeing is a healthy return to those considerations from the point of view of VC investors. Not all of them can do it. But a lot of them can and are trying to apply that, which is healthy. I think it's a healthy rebalancing.
Yeah, absolutely. And, again, there's a space for different pieces of the capital stack, which you ran through the different types of capital that are out there. And we could talk for days on this, but in the interest of time, I'd really like to get to, okay, when these companies when they get to a certain size, a lot of folks, unless you're in the corporate finance world or you're in the investment space, you generally tend to think that the way a company grows is through developing products, being somewhat innovative, having good marketing and advertising campaigns, keeping their expenses less than their income, their revenue, and so on. And that's how they grow. And there's this whole world of finance, which allows so many other opportunities. Like I remember the first time I saw a balance sheet for a non-financial company that had income from investment activities on their balance sheet and their P&L. It's like, well, that doesn't make sense. They're not even in the financial services space. What is this all about? And it came back to the fact that there's financing available and there's investment opportunities available for companies to help them shore up their balance sheet and their cash flow statements, right? But on top of that, there's the M&A space and there's raising capital. Like you were saying, there's raising capital for growth initiatives of different types. And so what are some of the trends that you're seeing right now in the institutional finance world that is helping companies to grow outside of the realm of just, hey, let's do bigger advertising campaigns and make more profits with the existing products we already have?
So I think so we're exclusively in the private space. We only raise capital and find investors for unlisted companies. And just in big picture, so the listed securities market worldwide is 120 trillion, and private funding space is 10 trillion. So less than 10%, but growing. And at 10 trillion, you're in a space where any company can fund itself and grow forever until an exit, which could be an IPO or trade sale or SPAC or whatever the shareholders decide to do. And in that space, so we've gone on the early stage side. We've got VCs that have become, let's say, more prudent, but then you have a very dynamic market these days in the private credit space. So a lot of credit funds, which are becoming incredibly active, and private equity funds who differentiate themselves from VC funds, and that VC funds typically only ever take minority stakes, whereas PE funds take control and controlling stakes and buy businesses. So in private credit space, for example, you have a huge capital, huge amounts of capital available for growing companies who've raised their equity, who are profitable, and who want to raise non-dilutive growth capital. And then they go to these private credit funds, and the larger private credit funds have strategies that cover the whole debt spectrum, from senior debt to junior debt to structured credit, mezzanine, etc. And they will say to these companies, like, what do you need and how much do you need? And we'll figure out what kind of risk you're asking us to bear, and we'll take the capital from that pocket and give it to you. And that helps. And typically these funds are pretty large, in the several billion size, so that they could put large amounts of capital to work, 10, 20, 100, 200, 300 million. At a pop, which is a large amount of capital for most companies to keep on growing. And then they're very active now. They've been very active since the financial crisis, because basically banks just withdrew to about 30% from the credit space since the financial crisis. Varies country per country, and all these private credit funds have not even begun to cover the space that the banks have basically abandoned. And so it's a very dynamic, very active space across worldwide, US, Europe, Asia, and then you have
Just really quickly on that one, Charles, because this is I think a really important point. If you're a private company, then of course there's different ranges, right? There's all the way up to the multi-billion-dollar. I think Stripe is still a private company at $70 billion value market cap, right? And there's a number of companies that are like that. Then there's companies all the way down into the tens of millions of dollars, valuation. And they hear these kinds of numbers like, oh man, there's no way I could even access that market, or what would I access it for, or anything like that. And they don't understand that there's money available for all different sizes of companies. And to your point, there's different risk tolerances, right? The senior debt, obviously least risky, down to, like you were saying, equity, most risky for a lot of these companies. But give us an example, like what's the time frame that it takes from a company saying, hey, we'd like to raise capital for this growth initiative, right? One company that came to our table recently was, we need to build a new manufacturing plant because we're getting to capacity of our current one. So we need to raise about $50 million to do this. Like, what are you guys seeing as like the tenure, the amount of time that it takes for somebody to go from maybe starting this process to getting funded? And what are some of the pitfalls that people run into along the way? So I think there's a misconception with a lot of people that I just go to a bank, I'd apply for a loan, they give me a loan, I can use it for whatever I want. And I'm pretty sure that's not the case.
No, if only. So the banks are the most risk averse investors by definition, because their capital and their capital is the cheapest. So the two are intimately linked. So the main criterion I think to bear in mind is the EBITDA multiple, right? Typically a company a normal company, putting aside structured finance and more complex transactions, but a company can usually raise up to 3.5-4 times of its EBITDA in debt, all debt, bank debt and private credit. So if you're at 10 million EBITDA, you can go typically max out at 40 million in 35-40 million in debt. If you have already 5 million in debt, then you can top up with private credit, typically to the tune of 3.5 to 4 times EBITDA. And that's broadly, that metric applies pretty much worldwide for corporates. So it's a question of, well, how long does it take to that kind of EBITDA? So then the question is, how much EBITDA do you really need to rebuild to tap into these funds? So doing the math backwards, typical, the lowest ticket that a private credit fund would go would be around the 10 million, right? $10 million mark, which means 4 times that EBITDA to reach 10 million, 2.5 million EBITDA. So once you get to 2.5 million EBITDA, you're into a space where you can knock on the doors of private credit funds, as well as your bank, of course, to raise private credit. How long that takes, some companies do that in 2 years, others take 10 to get there. But that's really the one consideration to bear in mind. And then after that is, okay, what does that credit look like? Because there's, again, depending on the risk profile of the debt, you get different kinds of debt. So typical bank debt would be straight line amortization, where every single month or every single quarter you need to make payments. When you go lower down or higher in the risk profile, let's say for mezzanine debt or junior debt, you can get debt structures that are much softer, where you can get bullet debt, so no capital amortization for 3-4 years, and then amortization at the end, or partial amortization, or much softer amortization, in exchange for, of course, a higher coupon and a higher remuneration for that debt, because the lender who's letting you play with his money for quote unquote with his money for three years without reimbursing the capital is assuming a greater risk than a bank who's basically amortizing the debt that they've loaned to the company every month, right? So, but I think the one answer to your question would be 4 times EBITDA, I think, is the short answer to the question.
And Charles, we could go all day about this. I love talking about this stuff because it's a world that most people don't have any idea exists, right? A company might be sitting out there and they're sitting at 3 million EBITDA right now. They're saying, well, I don't really know how to grow. I don't know what to do. Maybe I should sell my company. Well, what if you could access the private credit markets and then take that money and go to, start buying companies and buying more EBITDA, right? We work with companies doing that on a regular basis, and they just don't even know this exists. So I'm really excited that we had a chance to have this interview, Charles. We are at time here. So why don't we tell folks how they can find you and learn more about you, and maybe reach out to you about, having a strategy session or consultation if it makes sense.
Of course. Yeah, no, more than happy. Of course, we do that every day. So, our website is www.cognitivecf or cognitivecorporatefinance.com. So www.cognitivecf.com. And, all our contact details are there. Feel free to write to us or call us, and we'll be happy to have a conversation about any of these topics.
Beautiful. Charles, thank you so much. We'll make sure we put all of that information into the show notes. So if you're watching this, check the description. If you're listening to it, make sure you go check out our page and read all the show notes about this. Charles, thank you so much for being here today. This has been the Angels, Exits, and Acquisitions podcast with Angel Investors Network. My name is Jeff Barnes, and you've been listening to Charles Toma, and we are really excited to have you here. So as always, like, subscribe, and share. Thanks so much for being here, and talk to you guys next time. Take care.
Thank you very much, Jeff. Bye-bye.